Perfect. Thank you, everyone. And we have Brad from Global Risk as well, helping me out. I want you to feel like this is an informal setting, that you can ask questions anytime, so please do. I also hope that at the end you'll stay and network a bit. You've now made an introduction. Maybe there's someone in the room that you'd like to reach out to at the end and pass along business cards or make some connections. So once again, thank you for coming. We'll get started. I've got 5 main segments of the presentation that I'm going to cover today. First, I'll talk about what shadow banking is. I'll talk also about the size of the sector, where it exists, the trends we're seeing, some areas to watch, Canadian perspective, what our home jurisdiction looks like from a shadow banking perspective, and some regulatory considerations. 4 key takeaways for you today. You'll see that shadow banking has benefits. It also has some risks. It's a large and diverse sector, and it's growing. The things that drive the risk are concentrations, funding mismatches, and lack of transparency. And you'll also see that we've come to the conclusion that introducing regulation to mitigate the systemic risks involved is a rather challenging thing. So with that, there'll be a quiz on that later. We'll start with what is shadow banking. So the term shadow banking was actually coined during the financial crisis by a senior executive at the asset management firm PIMCO. It was used to describe the sort of complicated off-balance sheet vehicles that Western banks were using. So that's where it came from. The shadow, it implies a bit of hiding. It's a bit gray in the background, maybe a bit nefarious, but it's actually meant to be more broad and is used to refer to market-based finance. But like a bad nickname, it has stuck. So don't think of it just as a negative in terms of it being in the shadows. There is not one consistent definition, however, for shadow banking. It means different things in different jurisdictions, and different bodies have defined it differently. The common elements to it would be that these institutions are not deposit taking and that banking regulation does not apply, but they do things that banks do. The Financial Stability Board, which is the G20 watchdog for policy, calls it credit intermediation involving entities and activities that are fully or partly outside of the regulatory system. The fully or partly was this year's addition. The definition keeps morphing a bit as we go along. But that's the most accepted definition, and I think the Financial Stability Board has also narrowed its definition when it looks to monitoring shadow banking. So not only does it stick to credit intermediation for firms outside of regulatory environment, but it narrows it to those that pose systemic risks. So I'm going to break this down for you a bit. First of all, what do you think of when I say non-credit intermediation? Is there an easier way to say that? What do we got for non-credit intermediation? Lois, what do you think of?
First thing that jumps to my mind is that hearing about lately as well.
Yeah, I think a lot of people, we got nods of heads. You think lending? When I tell you about credit intermediation, it is one of the elements of shadow banking. Mortgage companies, consumer finance companies, auto lenders, leasers. The other thing that I think comes to mind, or maybe it does to my mind more recently, because it's an area that I find interesting as well, is the fintech space. So we have a number of financial firms, again a term, fintech, that's not that well defined or universally accepted definition, but we have a bunch of companies that have emerged in this lending space, facilitated by technology. So we all have computers with internet. We can easily search for loans on the internet now. You type in loans and you'll get a gazillion pages of different options. A lot of them are brokers looking to get you in the door and that they refer you to another place. But there's been a change in the landscape of consumer finance. We have Lending Club is the largest, or claims to be the largest, peer-to-peer lender. And peer-to-peer lending is, you can go online and look it up, it's kind of cool. you as an investor, someone with some money in your jeans, and you decide, hey, that bank deposit isn't paying me enough, I'd like to earn more. How can I do it? Those banks make lots of money lending. You too can be a lender. You can go on Lending Club and you can decide what kind of loan you want to give. And Lending Club does loans anything from financing your operation to buying an engagement ring. You can do it all on the Lending Club. It's consumer finance, it's unsecured. And again, bringing together people who want to invest, just regular people like you and me, to borrowers who need money. They have initiated $26 billion in loans, and the growth trajectory looks like this. Another one doing a similar thing is Innova, and it's not a peer-to-peer platform, but it's a consumer-based financing that has a huge book and also a huge growth trajectory. Who are these people? They're either investors, they can be corporates. You can see a few bank names on there as well. That banks are now investing in financial technology solutions. So that's all part of non-credit intermediation. But we're still on the lending side, and lending doesn't actually account for that much of shadow banking. So what else is there? There's credit-based investment funds. So all of the money market funds, mutual funds, exchange-traded funds, hedge funds, anything that deals in credit, that's actually credit intermediation. Those funds are taking money from investors and they're deploying it in investments that facilitate credit sources for corporates and other types of borrowers. That's a big portion of non-bank credit intermediation. Also, the securities financing world, the repos, sec lending, and other intermediation, that is too shadow banking, non-credit intermediation. Also, securitization activities. So back to what drove this definition in the first place, it was actually the securitization activities. Our friends at the Financial Stability Board don't have cute pictures like I do. They have a chart. So they do the same thing. They look at economic activities and the players, and they have break it down into 5 economic functions that pose systemic risk. So again, that's one of the themes of what the definition is all about. Similar to mine, I had 4. FSB has 5. You may notice the difference. It's in the credit insurance companies, the 4th one down. I didn't put that on there because it's very small now. If you think of the monolines that insured a lot of the structured vehicles during the heyday of structured vehicles, that's there, and other forms of credit protection also in that category. It's so small on the pie chart. You'll see it a bit later, but there you go. So why do we have shadow banking? Shadow banking has its benefits. It increases credit availability, more lenders. It increases credit availability in the form of more lenders that do things banks don't do. If you couldn't get your financing in a bank, you need to get it somewhere else. Non-bank lenders can fill the gap. Also provides more sources of liquidity to the system. All of that supporting economic growth. Good things, right? And diversification of risk. More players to spread the risk across. Fosters innovation. So we can do things without the regulatory rules faster, more creatively. Back to my example of the peer-to-peer lending, supporting innovation. But like everything that has benefits, we also have some risks. Risks both for consumers, investors, and the financial system itself. When I started my research on this, I was really focused on the financial stability and risks to the system. I thought that was where the risks are. But the more I read and understood about shadow banking, the more I thought we better add those consumers and the investors in there as well. Different risks are being posed to those groups as well. We'll cover all 3 types. But quickly, starting with the borrowers and investors, I'll spend more time on my favorite, the systemic risks. So what are the risks to borrowers and investors? Here I've given you the lovely graph of debt to income for Canadians. You'll see that we're now over almost at 170% and a huge growth trajectory on that. It means we're borrowing more. If you can't get your financing at a bank, you can get it at a non-bank. Again, back to those online fintechs, there's a whole world focusing on just subprime lending. So people who can't get their financing at a bank. We also have investors with lots of money going, I don't want to put my money in a bank account that gets me next to zero interest. I could get a GIC, but what do they return? 1%? It's created a new dynamic for investors searching for yield. You want to find somewhere where you can get your money, get a better return. But do we all understand the risks of what we're getting? What we see on the risks to the individual borrowers is they're taking on more and more debt. These are people already vulnerable because they've got higher debt levels relative to their income. They're vulnerable to shocks in their own life if they lose their job, but they're vulnerable to the upside too. If interest rates go up because the economy is doing really well, they're vulnerable to refinancing their debt at a higher level. Investors, on the other hand, if all goes well and rates go up, they might not want to put their money in these types of investments. But while they're in there, do they understand the risks of what they've got themselves into? I'll read you a couple of headlines. Or tell you about some articles more. I'm using my notes here because I've got to remember the specifics. So Financial Post, April 24th, had a really great article on syndicated mortgages. These are club loans, groups of private investors who get together exactly doing what I said, looking for yield. They think, real estate, look at how the values of real estate have gone up and up and up. I want into that. So they join these syndicated mortgages. They're organized either by a broker for the borrower or an agent of the borrower that goes into even community groups and says, look at this great investment, it's so secure. So do they understand the risks? The Financial Post article was about investors claiming the true nature of the investment was not disclosed. And here's a quote from a 62-year-old retiree that saw $250,000 in retirement savings wiped out. I just never anticipated this money was really at risk. So did the investor understand what they were getting into? Were the risks fully disclosed? Globe and Mail had a great spread on April the 1st. It was a Saturday. There were multiple pages on mortgage investment corporations. These were the opportunities to again invest in real estate in a different way. When things go bad, unsophisticated investors who are sold on promises of secure, stable returns are often those left holding the bag. I really didn't know what the risk was in this type of investment. Another one that I uncovered was the auto finance area. It used to be in auto finance, you'd go to the dealer had a captive financing company. So you went and got a Ford Motor Credit provided the financing. Now, auto loans are everybody's game. There are so many providers. And when you have so many providers, it's competition. When there's competition and a strong economy, what do you get? Looser credit terms. So you walk into the car dealership and say, I'm kind of a Honda Fit type of person in terms of my budget. I want something small and inexpensive, and I can afford X, let's call it $100 for my payments. And they say, oh, $100, you could drive a Cadillac Escalade. And everyone goes, wow. And what they don't realize is that what used to be a 5-year auto lease is now a 10-year auto lease. You're just borrowing for 10 years. You're paying interest over 10 years. Yet you still go back in 4 years and say, I'd like to drive something else now. So you refinance, but you've got negative equity. Your car is not worth your loan. So what they do is say, that's no problem. And they roll it into your next loan. So you're on this upward climbing treadmill of more and more debt. And at some time, you're not going to have the cash to repay this. The other thing that I thought was really interesting about some of these auto lenders, they have a kill switch for your car. They have a GPS, and they have another set of keys. So if you don't make your payment, your car is gone. Do the people who are entering into these financing agreements really understand that this is what's going to happen? Or is it kind of glossed over in the explanation? We can all go and try getting a car loan and see what happens. I haven't done my independent research from that perspective yet. But just a couple of the risks to borrowers and investors to keep that in mind as well. But back to my favorite, systemic risks. So what are the activities that pose systemic risk? We have something called maturity and liquidity transformation that leads to your liquidity risk, and use of leverage is your usual driver for solvency risk. But liquidity risk, you see the arrow on the far side, can cause you solvency risk. So you can have all the assets in the world, but if you don't have money in your pockets to pay your creditors right away, you might fail. You might get wound up. Does this sound sort of familiar to something in the news? Liquidity risk versus solvency risk? So we'll move on to what do I mean by maturity transformation. It's simply using short-term funds for long-term assets. My example there is the banks. And banks and non-banks all use this same risk transformation, maturity transformation. If you collect demand deposits and you use them then to turn around and finance mortgages. So what can happen? You've got short-term funding and long-term assets. Anybody? What could happen in a bank?
Interest rate can change, right? During the time give you a negative interest margin.
So you've got to hedge your interest rate risk for sure. Yeah. What else can happen that could cause you problems if you're using short-term funds? Did you have something? Very good. Run on the bank. So you hear that your institution is having some problems. Think of the news lately. Your institution is having some problems. What do? You go and get your money back. You're worried that your deposits will dry up. That they won't be able to pay your deposits back. So you go and get your money back. Yet the firm still has all these mortgages. It can't finance its operations. Back to you can have all the assets in the world. If you have no cash, you might be out of business tomorrow. So my example here really is banks, right? Because I said to you earlier on that the definition of non-bank is they're not deposit taking. Same idea on the funding source. If you use short-term funding for your long-term assets, you might run into problems rolling over your funding. If someone has if the market has concerns about your firm, you might not be able to roll that paper anymore. Then you've got the same problem as the run on deposits. So liquidity transformation is similar. My example here is money market funds take all of our money in a mutual fund and offer to redeem it anytime we want. Then they go and buy things that are long-term. If you think of fixed income funds in particular, let's say an infrastructure fund, you think infrastructure is the place to go right now. So you want to invest in a fund that's invested in infrastructure. But infrastructure is not something you can sell tomorrow and liquidate, yet you can get your money back anytime you want. So there's the risk. Same thing, a liquidity risk. Everyone says, oh my gosh, that fund is no longer where I want to have my money. If everyone, herd mentality, tries to get their money back at the same time, they're left with assets and you're left with, I need my cash. They might not have the cash to redeem. So those are the risks run by non-banks and banks. So you might be asking yourself, why is the regulation different? Why do we allow banks, or why do we enforce rules on banks and they have to play in a certain box, whereas non-banks, not so much the same regulation? So the difference is something in academics that they call the social contract. I kind of liked this concept, that you get something in exchange. So banks, in exchange for being regulated, get deposit insurance for our deposits. They also get liquidity backstop. So if banks can't get money in the markets because something's happening today, they can knock on mom and dad's door and say, give me a loan, and the Bank of Canada will respond with some cash. If you're not solvent, it's a different story, but this is liquidity. Liquidity is king here. So why does the government do this? Protects us as taxpayers, shareholders, stakeholders, depositors, and it provides stability to the financial system. You're less likely to worry about your safety of your deposits if you know the government is guaranteeing them. You're less likely to worry about the stability of your bank if you know there's a government backstop. Not so much for the shadow banks. So there is more susceptibility to bad news in the shadow banking community. And that kind of covers my next slide. Why is shadow banking a concern? You'll see the third bullet there is that most observers agree that this was the cause of the financial crisis. So if you think back to Lehman, Bear Stearns, that sort of thing, crisis in confidence, people wanted their money back. They thought, oh my gosh, those investments aren't worth what I thought they were. Better get my money. Liquidity dries up. Entities fail. Could it happen again? Yeah. So what are the drivers of the risk? Why are we not doing anything? International Monetary Fund says the drivers of the risk, and I agree with them, would be liquidity mismatches. So it depends on how much of that maturity transformation is going on. Leverage. Depends how much leverage we're using. Concentrations. The more we have concentrations of risk, the more potential there is for a problem. And transparency of risk. I think that's an important one too. The more you understand the risks you take, the more comfortable you must be with taking them. When you don't understand them, you could be susceptible to, one, losses, but two, that herd mentality of, oh my gosh, I better jump when everyone else is jumping, and you're then all on the same side of the ship and we tip the boat over. So now I'm going to move into shadow banking size and trends. We'll come back to what the regulations are and how things are changing, what changes have been made, a lot of positive ones, after we get through how big is this. Because size isn't necessarily a reflection of risk, but we should understand what we've got here. So you'll see I've got some interesting statistics here from 2014. This is from the Financial Stability Board. I got all excited last week when the FSB released its updated results for the end of 2015, except for China wasn't in it. So they've been doing this monitoring since 2010. Every year there's an annual report. Every year they get more data, more information to help you look at the risks and the size and what's trending. Except this year there was no China. They weren't ready to report yet. They promised to report next year. So I stuck with, on some of my slides, the 2014 data because I want to talk about China. And you'll see in some cases I'll give you some 2015 statistics to be a little bit more up to date. But a big sector, 36 trillion US dollars, and about a quarter the size of banks, growing faster than banks, also growing faster than GDP. What's driving the growth? 4 things. Regulation. So the more you put controls on banks, the more you will look for ways to do things outside of the banking environment. Less controls, so you can do more things. 2 and 3 in the second bullet, the low interest rate environment. I talked to you a little bit earlier about people wanting to get a better bang for their buck. The other going along with that is ample liquidity. We have cash. We're looking for a place to put it. Both of those contribute to the growth of shadow banking. They need to get their money somewhere. They need sources of funding. That's the ample liquidity part. And technology, that's the fintech part as well. New technologies, new solutions. We can reach new people. We can give new options. So more growth for the shadow banking. So now I will show you shadow banking around the globe. Dun, dun, dun. Look at that big US chunk, 40% in the US. You'll see Canada on the right-hand side, that little CA, 3%, $1 trillion. UK is 11%. Other Europe would be 21% if we combine them all. And there's China, 8%. This is why I didn't want to go without China. Although here we are in the 2015 report, without China. Addition, KY at the bottom is Cayman. So first time Cayman's being included. That's pretty relevant. Cayman is a big financial hub. So there's a fair shadow banking sector related to that. Canada, still on the sort of, I guess about 2 o'clock. It's 3%, so pretty stable from a global perspective. The size of the pie here is actually smaller at $34 trillion. I tried to do some math on what
Yeah.
the influence of China was, but I gave up. So it was 36 trillion without China the year before, 36 with China in 2014, 34 without China, but it's still growing. So I'd like to see the China results. So that's where it is sitting globally, large concentration in the US, Europe, not so much in Canada, and China a growing chunk with that 8%. But size alone doesn't necessarily equate to risk, so we have to look at a few other things. We can look at the sector size versus GDP. Look at Ireland. Margot, why is Ireland so big? Yeah, the Irish banking system is huge. The whole Irish financial system is huge. They went through a period of time of trying to entice growth in Ireland, ended badly, if you recall. But they had really low tax rates. They were trying to have really high deposit rates to attract funds. It is the domicile for a lot of funds. In fact, the biggest concentration in shadow banking in Ireland is funds, investment funds. I thought it was kind of interesting that the US isn't the biggest by GDP. I kind of felt a little bit of relief on that. And then you see Canada down at the number 9 of 10. So the average in 2015, and there's a lot of disbursement around the average, was 66%. Just to put those in perspective. So you can see France on up is bigger than the average. Then in the 2015 report, instead of giving me comparable data, they gave me growth rates. And I couldn't find the underlying data source. But you'll still see Ireland growing very strong. In fact, the only anomaly here I thought was interesting was the United States is growing less than its GDP. And there's Canada, quite a big growth rate. 9.8% versus 2.9 on the GDP side. We'll talk about Canada specifically in a little bit. So what I did in my research was said, well, size alone doesn't matter. It depends on the level of risk. So how can I figure out where I think are the bigger risks? So certainly size is important. Relative size with GDP is important. Growth is important. So I made myself a nifty chart that shows the areas with all of those, the big concentration, high growth, and a big portion of GDP. And you'll see in the red there, China grew 4-fold. So it grew from a relatively small base, but it's grown quite significantly. Ireland is just big, and I think just saying that it's largely funds doesn't make me feel all that comfortable, because funds have a lot of maturity transformation going on, particularly those bond funds. Remember my infrastructure fund example? That's an area to watch. And the USA, because in particular, it has a lot of really big broker dealers, so that are not associated with banks. Because the ones that are associated with banks are covered by bank regulation. So those to me are the areas to watch. So what type of activities, back to that lovely, not my cute one with the graphics, but the FSB definitions and the economic functions. I really liked their legend for this. Just they give you the economic function without telling you what it was. So I typed in what it is. 65% is funds. Biggest one. Second biggest is the broker-dealer segment. That's the securities finance, largely. Third was securitization. Is that right? And third is non-bank lenders, and fourth is securitization. Have I got that right? No. Okay. There we go. And you can see the growth rates on the right-hand side. Funds are the biggest growing, non-bank lenders next biggest growing. Funds concentrated in the US. Half of that is US. Broker-dealers is US, UK, and Japan are the largest. The lenders, it's US, and US is about 30%, and China is 20%. And now for a Canadian perspective. $1.1 trillion sector. It is 2.9% of the global total of shadow banking. And it's about half the size of the traditional banking sector. Remember, it was about 58% of GDP. So where's our concentrations? We are about half in the investment funds, 29% in the broker-dealer side, and another 6% in other market intermediation kind of activities. We have I think, is it 10%? Sorry, I have really bad eyesight, and on the screen here it's even smaller. I think we've got 10% in the lenders. So those are our biggest sectors. Do we have risk? Well, quoting from my friends at the Bank of Canada, the risk appears to be moderate. We've got a limited degree of maturity and mismatches and liquidity mismatches, relatively low leverage in most sectors, and small individual subsectors. The ones that are the riskier ones are smaller. So overall, we assess that it's a fairly low vulnerability. Feeling a bit better about Canada. But we do have an evolving mortgage market. If we go back a couple of slides, if you see just about at 12 o'clock, there's one little sliver of very thin that says 1% on the top. Those are those mortgage companies. It's a growing segment. The definitions of the types of firms involved would be mortgage finance companies, and I've given you some details there. Mortgage investment corporations as well. Those were the ones I read to you the paper announcements about. They are based mostly on private investors. The mortgage finance corporations, they're generally, mortgage finance companies are generally brokering, collecting mortgages that then they sell to banks. So if they sell to banks, they have to follow the bank rules. So that's not really shadow banking. We don't count that part. If they're going to use the securitization that's government supported, NHA, you need to follow the rules. So it's a smaller portion that is true shadow banking, and that's the little wedge of 1%. We also have the growth starting from a small base, but still growing, the higher risk private money. If you can't get your mortgage at a bank because the rules keep getting tighter and tighter, the real estate market keeps going up and up, and you still want to buy that home, you need your money somewhere. You try a non-bank that lends to non-prime customers. If you can't get it there, you can go to a private lender and get your money. Remember, the internet's out there. You can find these sources of financing a lot easier than you used to be able to. So that's contributed to the growth. But the biggest section here, not necessarily shadow banking, but is the mortgage finance companies. So there's 4 main ones. I like this slide because it just shows you how much it's gone up. It kind of probably looks like how much the real estate market has gone up as well. And again, same drivers, demand being the primary one, but the IT advances as well. This is 4 companies just basically doing this. It's kind of interesting. But where's the systemic risk here? So we've got some companies, not the ones that are securitizing their mortgages or selling them to banks that are following the bank rules, but we have others that are taking on riskier assets. Those firms can have lower levels of capital and contingent liquidity, because remember, they exist outside of the regulatory perimeter, so they don't have to follow the capital rules or the liquidity rules. And they have more concentrated sources of funding. Primarily, they're looking to sell their mortgages to banks. That can dry up in a crisis. I'm now looking for my notes to give you some information about the riskiness of the portfolio. So, share of mortgages with greater than 450% of income to debt, or debt to income, sorry, or a total debt service ratio of more than 42%. For these companies, they're about 29% of their portfolio versus 18% for banks. So the spectrum is a bit different. The curve of risk distribution is skewed to the higher risk borrowers. And again, those are the borrowers that are more vulnerable to economic downturns or even good times when the interest rates go up. This is one of the areas that the Bank of Canada is taking a look at. That and the fixed income funds as areas of risk because of the liquidity transformation and the size. So regulation. Why do we have different regulation? Why are we not jumping all over this? Good questions. Since the financial crisis, we have seen tons of increased regulation for banks. Higher capital rules, new liquidity tests, leverage requirements, Basel II, Basel III, and in fact, some of the riskiest activities of shadow banking were addressed. So they have central counterparties now to help control some of that risk that was kind of not transparent in the system. More change in accounting rules for securitization vehicles. So we've seen that change. Also, the prevalence of complex structured products has took a big nosedive. But specific to shadow banking, what happened was the G20 said to the Financial Stability Board, guys, go figure it out. Come up with what we should be doing here. And they've been doing a ton of work at the FSB to collect data, figure out where the risks are, come up with ideas of what we should be doing about it. And that's been some of the basis for the slides that you've seen too, is my data is coming from them. So they implemented this monitoring in 2010, 27 jurisdictions, now 28 are reporting, should be 29 if China were reporting this year. It's about, I think 80, maybe 90% of the global GDP. So we're getting it from most of the big places. It's what we're trying to cover there. And in 2013, they implemented a policy framework. But it's guiding principles, and it's not hard and fast rules. Remember, this is a largely less regulated sector. They don't follow the bank rules. So what have we got? A framework that talks about qualitative things. And they're all good things. They should be targeted. It should be risk-based, forward-looking, adaptable, effective, blah, blah, blah. That's all nice. But in May 2016, they did a little check-in to see how are we doing in terms of implementation, and the answer was not so great. And the reason is it's complicated. So the regulators face a lot of challenges. We started with the definition of shadow banking. We can't even agree on a definition. It's unregulated. How do you get firms to report then if they're not regulated? You ask nicely. There's differences around the world in the breadth and the scale of operations. So some care more than others. The sector keeps evolving. As it always happens in a credit cycle, the longer things are good, the more creative things get, the more the edges kind of drift and the envelope expands. We're seeing that here in shadow banking as well. But the other aspect is, if you just applied bank rules to non-banks, we'd have no non-banks. It'll be banks. So you would take away the benefits that the system affords, right? We talked about some healthy competition for banks, increasing credit availability, market liquidity. All of those are good things. Being able to innovate, all good things that we don't want to squash. But are guiding principles enough? Should we try and find some form of regulation? What can we do to control it? My own thinking is you can't wait for a crisis to put rules in place. It's a bit late. So I think you have to start somewhere. My somewhere on the systemic risks was liquidity is what really matters. So if we can identify the bigger firms or activities that are creating liquidity risk, Can't we come up with some measure to say big things have to have some sort of limit? I think that would help. Risk transparency was the other. This is the borrowers and investors that I got all worried about when I did my research and found out about those auto loan companies. I don't think the auto sales guy is telling you that you have a risk of negative equity. I don't think the lender on the mortgage is telling you, and by the way, if you lose your job and you can't pay me back and the market goes down, I'm going to sell your home, but I'm going to come after you for the balance. And these aren't banks with the same social pressures that exist to treat customers as fairly, right? We haven't seen this tested. So that would be my recommendations after doing my research.